if the RBA continues to think its rate rises should be having an impact on certain inflation, petrol, electricity, housing, that they're kidding themselves. It's not. That's not where the interest rate rise has the impact. The interest rate rise has the impact on discretionary income spend, and I would argue that even though house prices have, out of every asset in the world, nearly all of them have gone down as rate rises have gone up, except residential property in Australia.
Yeah.
And that's not because of monetary policy. That's because of the huge amount of demand.
Hello and welcome to another episode of What's Not Priced In. As always, I'm joined by Greg Kenneman. Greg, welcome again.
G'day, Kirill. How you going, mates?
Not bad. Now,
That's
it's
good.
a bit warm here in Melbourne. How is it over in New South Wales?
It's not too bad. It's I wouldn't say it's warm, but it's getting a little bit balmy. So I think there's thunderstorms due at some point in the next couple of days. So warming up a little bit. It's been pretty cool here. So good to see some summer coming.
Yeah, well, it's certainly warming up here and definitely warming up in the markets as well, if I can make a pun there. Now, we'll mention the interest rate decision by the Reserve Bank a bit later in the show, but I thought maybe we'd start off where we left off last week and then maybe talk about the action over in the US. Obviously, you said last episode that this was more of a bounce in the US rather than a sustained rally, and that's because not necessarily of what the Fed did, but because the stocks were oversold late in October and it was due for a bounce. Now, stocks have continued to rally this week. I think the big tech stocks have rallied as well. I think Microsoft neared its all-time high overnight on Tuesday. We're recording this on Wednesday. So what do you make of all of the moves? Have you changed your opinion about the bounce or the rally?
No, not at all. I think that pretty much what we discussed last week still stands in terms of the interpretation. We recorded that last Thursday, and that was in the midst of a pretty strong rally from US stocks, and then that day or that day's trading in the US, the Fed come out and indicated that it was pretty much close to sitting pat on interest rates. So the market got an extra impetus from that. And pretty much when you get oversold conditions, the market will take those opportunities as a bullish signal. So I don't think fundamentally there's any reason to justify this being a lasting bottom. And when you consider the fact that, yes, central banks may have finally stopped raising rates for this cycle, it doesn't mean that they're going to turn around and cut rates anytime soon. I think that's the key thing there, is that this higher rates for longer will persist until the US economy slows down quite sharply. And there are some charts that I'm going to show as we get into this episode, which indicates that there's, the US economy is going into recession, and there's some reasons why that is not evident at the moment. But the way the market is priced, it's pricing in a pretty robust earnings outlook for 2024. And if it doesn't pan out like that, the US market is pretty overvalued. So you have to be cautious. And this rally, as I said, it's more of a reflexive rally based on oversold conditions. We're starting to clear those conditions now. So I wouldn't be surprised if we do get a bit of a pullback in the next couple of days. But having said that, we're moving into what is traditionally a reasonably good seasonal time for the market. The market traditionally rallies in November and December. They're traditionally pretty good months for the market. So don't be surprised if these conditions continue for a little bit longer, but I wouldn't say that the lows that we saw back in October are potentially lasting lows. I think there's still some more challenges to come.
Yeah, and what would you say to those in the market that are thinking the current rally is sort of based exclusively on the Fed probably stopping its rate path, and those who are saying bond yields are going to continue to fall, and therefore stocks are going to be relieved of that pressure, and people are going to rush in and buy stocks? What would you say to them?
Well, I guess there's two things that you've got to look at. One of the defining features over the past week or two has been the big decline in long term bond yields in the US, and also Australia. The same things happen. So the US 10-year bond yield has fallen something like 30 or 40 basis points, and that has been a big reason for the rally in stocks, purely because stocks have been going down because bond yields have been going up. So now that bond yields start going up, stocks are going to go up as well. But the reason why I think
Mhm.
the bond market is reacting the way it is because it's seeing this slowdown in the US economy starting to emerge. And the big move was last week in the employment. When the employment indicators come out, there was a revision down of prior months as well. So the employment market is starting to cool, and that was a major factor for the higher for longer narrative. So if and employment's a lagging indicator. So if employment is starting to show signs of cooling, that means that we are into the slowdown. And I think the bond market is starting to price that in. So again, the equity market responding positively to that is purely a reaction based on
Mhm.
uh, what do you call it? Based on the discount rate
Yeah.
factor. So the fact that interest rates are lower for a given amount of earnings and cash flow, that the stock market will value that higher. But if the bond yields are falling because of an economic
Mhm.
slowdown, then you're going to get economic conditions that put pressure on earnings. And I looked earlier this week, and based on forward-looking earnings, so the earnings outlook for
Mhm.
2024 in the US for S&P 500 companies, analysts have penciled in a 12% increase in earnings per share in 2024. And the stock market trades on a forward PE of about 17.7 times those earnings. So that's probably, you could say, okay, that's a reasonable multiple. But if you don't get those earnings, the multiple goes up to around 20 times. And then when you're looking at a 10-year bond yield, which is still around 4.5, 4.6% in the US, at 20 times earnings, that's a 5%
Mhm.
earnings yield. That's not much of a premium on stocks over the supposedly risk-free rate of the 10-year bond yield. So in my view, the US market is still considerably overvalued, given that we are looking at 2024 with
Mhm.
considerable inflation risks, and I don't think those, even the probability of inflation risks, I don't think is being correctly priced in. Um, the equity risk premium is just historically very thin at these levels. So that's, I guess that's my caution. In saying that, in Australia there are a number of quality stocks that have been
Mhm.
marked down. And I think we're getting to a point where you can buy a lot of stocks at
Mhm.
pretty good prices. The Aussie market is difficult in the same way that the US market's difficult to sort of look at because it is so influenced by those larger stocks
Mhm.
in the index. And I'll show you a chart in a moment just to reflect that. But the Aussie market is quite skewed by the banks and the
Mhm.
resources. And if you strip out the banks and the resources, overall, the Aussie market isn't necessarily cheap.
Yeah.
So the banks and the big resource stocks generally trade on lower multiples. So if you strip those out, the industrials and a lot of the other stocks on the Aussie market, are not necessarily at cheap levels, but there are stocks within that that I think are quite attractive. So if we do get some more weakness in the months ahead, I think longer term investors should be taking those opportunities to buy. I'm just saying I would caution against thinking now is a low and you can get in and load up. I still think over the next few months you can chip away at the market and take these positions in stocks that sell off without getting too bullish and loading up at the moment.
Yeah, and I think something I wanted to maybe mention a little bit, something what you said about bond yields. It's something that I've noticed, I think, now for the whole year, where we're sort of in a bizarre world where sometimes bad economic news mean good news for stocks, and there's maybe a simplistic idea for some investors that whatever leads to lower bond yields is good, hooray, and whatever leads to higher bond yields is bad, and they boo it. But you sort of have to focus on exactly what causes the yields or the rates to fall. And if that's because the market expects the economy to stagnate or aggregate demand to plummet, that's not good news for earnings at all over the long term. And I think that's sort of where I think that's something I've been noticing, and it doesn't really compute in my mind. I don't know whether it computes in yours.
Well, often the market doesn't really make sense when it first reacts to something,
Hmm.
and then over time it becomes more apparent. And often when the market does react, it's not obvious at the time, but as I said, you can rationalize it, and you can see what the market was seeing before everyone else. The market is far smarter than you or I, so I always make sure
Yeah.
to give the market the benefit of the doubt plenty of times. I think in relation to what you're saying, what the market will respond positively to is a drop in inflation that
Hmm.
doesn't necessarily mean uh, a negative
A
economic
soft
growth
landing.
outcome. So as long as inflation, if inflation's coming down and that's the reason why bond yields are coming down, then the market will celebrate that.
Hmm.
If inflation is coming down because the economy is slowing very sharply, and that will impact on corporate earnings,
Hmm.
then that's not good. My argument is that the market at the moment is pricing in lower inflation, but still benign economic
Hmm.
conditions, and I question whether that is the right is the right interpretation. And I'll show you a chart just so you can get a sense of what I mean by that, because I think often people think, oh, it's just a matter of opinion. You're bullish or
Hmm.
bearish, and um, if you are bullish, you'll have a certain bias, and if you're bearish, you'll have a certain
Hmm.
bias. So um, these couple of charts come across my desk this morning from Dave Rosenberg, who runs an independent economic research shop. He's considered to be bearish or to have a bearish
Hmm.
slant, but as he often points out, he's only bearish when he thinks that the market is pricing in the wrong outcome. So
Yeah.
this chart here shows leading and coincident indicators, and the leading indicator is in red and the coincident indicator is in blue. So the leading indicators obviously show where uh, or indicate where the economy might be heading, and the leading indicators in this instance are obviously slowing quite sharply.
Hmm.
Whereas the coincident indicators, which is a reflection of what's happening on the ground at the moment, are still heading higher. And that's why you've got this real uh, different situation or weird situation where there's these constant calls and constant concerns about the US economy. Will it or won't it go into recession? Everyone's pointing to these indicators that suggest it's slowing down, yet you're just not seeing that in the data. And that this chart points that out quite clearly. So what Dave did is he put this into another chart and said the discrepancy this large is a reliable recession indicator. So every time you've seen this big divergence between coincident and
Hmm.
leading, you can see that all through here. And we've got a pretty big divergence here. It's only um, probably bettered by the big uh, drop back in
Hmm.
2009. So this was the 2008 09 divergence, very big one here. And each time you've seen these divergences, you've seen the US economy go into recession. So, building on what we pointed out in the episode, I think it was the week before you got back, just where I looked at Lacey Hunt's
Hmm.
research, there was a number of indicators, um, things like money growth, bank credit creation, all those things are pointing to recessionary conditions in the US. This is just another one. And the fact that it hasn't happened yet, or the fact that we're still sitting there waiting for that
Hmm.
coincident indicator to roll over, doesn't necessarily mean it's not going to happen. It's just going to take some time. And it doesn't necessarily mean this will drop down sharply as
Hmm.
well, but certainly the divergence should narrow. To me, again, it's all about probability. It's not about saying absolutely, I think the US economy will go into recession,
Hmm.
and don't buy any stocks until that happens. That's not how you should look at things. What you should look at is what is the market pricing in and what is the market not pricing in. And what the market's not pricing in at the moment is the greater likelihood of the US going into recession, and the implications for for corporate earnings, and the uh, effect on the PE ratio, and things like that. And just to point out, this is a chart showing the S&P 500 since the start of the year. which includes obviously all the big stocks, that's up nearly 14.5% from the start of the year. But when you look at it from an equal weight perspective, so stripping out the huge market caps of your Microsofts and
Yeah.
Apples and all that sort of stuff, the S&P 500 equal weight is down just down about 0.32% for the year. So that divergence, which is roughly 15%, it's all down to seven stocks. So if you haven't owned those seven stocks, you've gone nowhere. The S&P 500 has gone nowhere this year. But if you have, happy days, you're up 15%. And clearly you can see that big bounce we've seen over the past week. And while we're on the charts, let's just quickly run through because last week when we're looking at these charts, we were pointing out the RSI indicator, which is
Mhm.
a short-term momentum indicator, and saying that obviously got very oversold at these levels and has since rebounded. So this is the S&P 500. We're getting back up, not quite in overbought territory yet, and it may not get there, but it's certainly cleared that oversold condition that existed just a few weeks ago. And just to go through quickly on some of these charts, here is the Nasdaq, the Russell 2000. That's already started to pull back a little bit. So again, we've talked before about how the Russell 2000
Mhm.
is a more of a small cap index for the US. It doesn't obviously have those large mega cap growth, tech growth stocks in there. So this is struggling far much more than the larger indices, and it's already hit a bit of resistance at this 50-day moving average. So that sort of indicates that this oversold condition is starting to clear. So it'll be interesting to see in the next
Mhm.
week how this goes. And as you pointed out at the start, we're recording this at midday on Wednesday. I've got to travel tomorrow, so couldn't record it at our usual time on Thursday. But so we're only sort of early into the week in the US trading week. And in terms of the Aussie market, this only shows up to yesterday. Again, we've only rallied back up to the 50-day moving average. So as much as everyone's getting excited about this rally, we're still in downtrend, still below the moving averages here. And the market, Aussie market's up about 0.3% today, so might be getting towards that area today. And we just take a quick look at the bank index. Again, that's bounced back up, sold off a little bit here on yesterday's interest rate announcement. And the resources index hanging in there. It didn't really become oversold in the general sell off. It was one of the few sectors, thanks to the big iron ore miners, that are holding up nicely. And that's holding in there, but I wouldn't say this is necessarily a bullish chart. It's holding in below the moving averages, and I think it's pretty important that these levels hold.
Mhm.
And if they don't, then obviously you're going to see a pretty big decline. And we haven't looked at this chart for a little while, so I thought I might just bring it up. But it's
Yeah.
the iron ore price and the Chinese yuan. And as you can see, that diverged. When was that divergence? That occurred back in May. And the iron ore prices continued to move higher while the Chinese yuan relative to the US dollar has stayed pretty weak. So again, I'm not sure if that is a divergence
Mhm.
that will continue, or whether the iron ore price will fall back down. But this resilience in the iron ore price has been the main reason why the resource index is held up. If that resilience doesn't continue, uh, you're going to see falls um, below this level of support here, and ongoing falls from there. Now, just quickly, we'll go through. This is the small ords index.
Mhm.
Obviously, it's had a really strong bounce as well, along with the rest of the market, and starting to come up against a bit of resistance here at the 50-day moving average. So the key thing to note is in the Aussie market, the ASX 200 small ords both still under the moving averages. At the same time, they've
Mhm.
broken down out of consolidation channels. So even if we are at a low, it's a low probability bet to say, okay, I'm going to buy this low while you're in a downtrend. And there needs to be a fair bit more work done to become confident that that might be a rally that has legs. Uh, let's see what else is there to look at. Just on the real interest rates, we look at this. Um, Real interest rates are this is the TIPS bond price. So it's the inverse of real interest rates. So here we've rallied a little bit over the past couple of weeks, which indicates that real interest rates are coming down, and that's providing a little bit of relief for asset prices. So this is partly the reason behind the rally as well, and
Mhm.
that goes to the comment that you mentioned before, Kirill, about lower bond yields
Mhm.
helping asset prices because the market thinks, okay, well, lower yields equals higher asset values. So there is a little bit of relief here from that, and you're seeing that in the bond funds as well. TLT, which is the long-term US Treasury bond, rallied a little bit from very oversold levels. As you can see here, very oversold, rallied a bit, but again, only up to the 50-day moving average at the moment, seeing some resistance around there. And the Aussie bond fund that I track, which is a composite bond ETF, broke down below support here, very oversold at these levels, and has since rallied back above support. So it'd be interesting to follow this. If the RBA is done with their rate rises and the market reaction indicated that could be the case, this could be a false break of these long term lows, and it might be a part of this whole large bottoming process, which would be bullish for this bond fund. But I think it obviously got more work to do. Hasn't even rallied back up to the 50-day moving average here, so it still looks pretty weak. And just a couple of other ones on the issue of whether this is a lasting bounce or not. These are just some of the internal indicators that I look at. Last week or at those lows, we saw a lot of stocks that had been really oversold, and this is an indication of how many stocks have their relative strength index below 30, which is quite large. So that's come right back down, which indicates that this oversold condition is clearing. Similar thing here with the uh, amount of ASX 200 stocks above the 200-day moving average. So that's moving up as well. So all these oversold conditions are getting cleared. This one is new 52-week lows. So just a few weeks ago, you had a really high amount of ASX 200 stocks at 52-week lows. They've all obviously rallied from those lows, and that's come right back down to those levels. So all these indications that we're clearing oversold levels. Same thing here. Number of ASX 200 stocks within 20% of their 52-week highs. That got quite low here, really sharp falls, bounce back up. Again, this is starting to trend down. So I don't think this is the start of a new trend. I think this is probably going to continue down further in the months ahead. And lastly, the Aussie VIX index, which popped up a little bit, but it wasn't anywhere near the
Mhm.
stress levels that we've seen at these other major lows in 2022. So again, nothing really to indicate to me that this is a lasting low. And I just wanted to point out at the bottom here, Macquarie. I'll
Yeah.
get rid of this because I don't really need that. Uh, Macquarie is such a good stock to follow because it's a real indicator of the amount of liquidity, or what
Mhm.
the liquidity conditions are like, what the credit conditions are like in the global economy. Because Macquarie is your classic um, money shuffler. Basically, it buys assets, it repackages them, it sells them off, and when credit conditions are strong and liquidity is strong, Macquarie will do really well.
Mhm.
And when credit conditions are getting a bit tight, that's when Macquarie struggles. And this breakdown here out of this consolidation pattern is quite telling. It came out with its results last week, I think it was. Worse than expected. They did announce a buyback, which gave their share price a bit of a boost. But to me, this just shows a very well run company in dealing with conditions that are suggesting tight money, tight credit conditions.
Mhm.
And the fact that it hasn't bounced based on all this um, optimism that
Mhm.
we are, potentially at a point in the cycle where it's safe to go back into the water, is just another indication for me that we need to maintain a relatively cautious stance at this point. So, with that, I'll throw it back to you, Kirill.
Well, I think, yeah, thank you for that. They were great charts. Maybe I'll do a quick fire round and throw some questions at you based on what you've just said. You mentioned iron ore prices, and I think one of our editors, Callum Newman, really likes to talk about iron ore prices and how resilient they have been. And I think one question, obviously, is why have iron ore prices been so resilient?
Quick answer: no idea.
Okay. Next
It,
question.
it's it's. I think you have to be a real genuine China watcher to
Hmm.
understand. I mean, iron ore is all about China,
Hmm.
and if you look at what I've learned over the years, is that if you look at China from a superficial level, you'll generally get it wrong, and uh, often the layman will look at China and think, how can this continue? And
Yeah.
especially when it comes to the housing market, and they are trying to, I guess, do a controlled implosion of their housing market. So the question is, everyone knows they've been through a massive credit bubble. Everyone knows they've got challenging demographics. Everyone
Hmm.
knows their local governments have huge debt issues. Yet a centrally controlled economy, I think, has a lot more. I wouldn't say resilience. I don't know if resilience is the right word, but has a lot more levers to pull
Yeah.
to keep things going longer than what you think they can go. So um, it's a long answer to the question of I don't know why iron ore prices are managing to hold up as long as they are. The other one to really think about is China is probably becoming the steelmaker for the world as well.
Hmm.
Um, and this is the irony of
Hmm.
this whole green sort of revolution is that countries that say, okay, steelmaking is bad, we're going to shut down our steelmaking operations, it just gets shifted to
Hmm.
China, which has got even worse environmental regulations for their steelmaking than anywhere else in the world. So, um, as a guess, I'm assuming that China is just through its
Hmm.
almost environmental arbitrage because it doesn't have the environmental regulations that the West does. It makes steel a lot cheaper, and it will import the iron ore to make that steel. So uh, it's a guess, but the resilience has been there, and who am I to argue?
And if iron ore prices start falling sharply, would you be worried?
Not necessarily worried. Well, personally, and for my subscribers, I haven't got positions in iron ore stocks. I just think it's a, they're very well run companies. They've got world class assets, so they can produce a lot of this stuff at very high margins. But those margins will get squeezed a bit at lower prices. I think a couple of months ago when we were talking about this, I mean, Rio, for example, its share price fell below
Yeah.
$100, and that was the market saying, okay, we're pricing in lower iron ore prices, and then that turned around and back off to the races they went. So I'd be more inclined to want to buy them when the
Yeah.
market was starting to get more fearful and stay pricing in, say, $80 a ton for iron ore. But at the moment, I think that they're probably priced fairly if you think iron ore prices will stay high. But if you think iron ore prices are going back to $80, I wouldn't want to be buying them. And the other thing to consider if iron ore prices do go back to $80 is just the impact on I guess the current account
Hmm.
deficit in Australia, the trade situation and the royalty intake for some of the governments. But I don't think that's a huge issue. 80 bucks a ton, they're
Yeah.
still going to be making decent money on that for sure.
Yeah, and I think that's something that Callum has said for a while now, that even if prices go down from 100 to 80, the really well run iron ore companies are still going to be printing cash because their margins are so high anyway. Well, another question I have is, um, the economists that I follow, and I think something like Rosenberg or Lacey Hunt, there definitely seems to be a bit of a divergence in that community about where the US economy is headed. I see some opinions that sort of gloating about the recession that wasn't, and sort of making fun of economists that have been predicting a recession in the US for the last year. And there's others, for example, like Rosenberg and Lacey Hunt, that are saying, no, hold on, conditions are actually worsening, and just you wait. So there's definitely a divergence. And my question to you is, have you experienced this before? Is this maybe a common occurrence among macroeconomists that are always sort of maybe disagreeing with each other? Or has this disagreement been something that you've noticed more usual this year?
Well, I think it's probably more so than usual this year, just because of the really unique conditions
Yeah.
that the global economy's been through. Like the tightening cycle has just been extreme based on recent history. So anyone in the market probably hasn't
Mhm.
seen a tightening cycle
Yeah.
like they've seen, and the knee jerk reaction is to say, well, surely this will cause a recession. We've gone from a decade of QE and loose money to all of a sudden QT, quantitative tightening, and rapid interest rate rises. Surely that's going to plunge the economy into recession. I think what people probably aren't considering so much is how loose fiscal policy has
Mhm.
been. So the US economy is running budget deficits in excess of 5 and 6% of GDP. And I think next year's forecast is for over 6% of GDP budget deficit. So that has a huge counter impact on the ability of central banks to tighten money. And we saw that just this week. The reason why the RBA is having to tighten is because governments are running, a pretty loose fiscal
Yeah.
ship at the same time as letting in or opening the doors to a 500,000 people that are increasing demand, obviously for housing. Housing and rents have a big impact on inflation. So whenever you've got really loose fiscal policy, you're going to have especially tight monetary policy. Now, these economists are saying that there's enough evidence in the pipeline to say that monetary policy will win. And in Lacey Hunt's case, he talks about the longer term detrimental impact on economic growth of fiscal spending when your fiscal debt ratios are, I think, above 90% to
Mhm.
GDP. So what he's saying is that large fiscal spending that has happened since COVID will feed into have a negative feedback loop, a negative multiplier effect on the US economy. So again, it's about all those lags that you have to take into account and how long that will take. No one really knows. And to be honest, as an investor, it's not you don't have to really worry about whether a recession is
Yeah.
coming or not. What you have to worry about is what has the market priced in and what is the probability of a recession versus what the
Yeah.
market is pricing in. Now, as I said at the start, the US market is the analyst expectations for the S&P 500 is 12% EPS growth next year. So they're not expecting a recession at all. Now, I would say, is that a market that I want to invest in? Not that any of us are really investing in the S&P 500. Maybe a few people have got ETF exposure for the S&P 500, but just as a general example of how you should
Mhm.
think about it, to me, the probability of a recession in the US is much higher than what the market is pricing in. So if the market went down to putting 15 times earnings, then I would be much more bullish about the market. But at the moment, it's 17 times forward earnings. And if those earnings don't eventuate, you're looking at 20 times, in which case you'd want the bond market to fall considerably to even make the equity market look like a good bet at this point. So, and that comes back to the reason I've been saying to my subscribers, you probably should have a position in the bond market
Mhm.
at this time. Interest rates will bite; they will have an effect at some point. There is a lot of pressure on governments not to continue spending, and even
Mhm.
I think Treasurer Chalmers has been talking
Yeah.
about pulling back some of the planned infrastructure spending because he knows that that spending is having an impact and going to cause more interest rate rises than what
Mhm.
there should be, and that's not good at the ballot box. So, interest rate tighter monetary policy will win out, but it's having there's a bit of a tug of war effect at
Mhm.
the moment, and that's why you're seeing these divergences of opinion. And I read many people who say, there's no sign of an economy. No sign of a recession for the
Yeah.
U.S. economy. And you could argue that that's similar to Australia, and I would argue that in many ways that's probably right. There's
Mhm.
a certain subset of the economy that is experiencing recessionary conditions right now, and a lot of that is probably in retail and things
Yeah.
where mortgage owners are the ones that are really impacted, and there's other parts of the economy that are flying. So it really comes down to what sectors you want to look at for stocks, and then, as I said, what are those stocks pricing in? Are they pricing in good outcomes or bearish outcomes? And if the pricing in is more bearish than what you think is reasonable, then to me, that's where you should buy. But just speaking of that, like I'm not really seeing anything in the market at the moment that's really standing out as a contrarian
Hmm.
opportunity. It's sort of, like we spoke about REITs a
Yeah.
couple of months ago. Everyone hated REITs, and they've bounced quite nicely since the bond yield. The pressure has come off the bond yields, but again, they're still in downtrend, so it's not as if they've turned around or anything like
Hmm.
that. They still look like they're pretty good value longer term for me. If you think inflation has peaked, but in terms of other sectors in the market that are particularly interesting from a contrarian perspective, I'm probably struggling to find sectors. Maybe there's individual stocks out there that you could look at, but from a sector perspective, it's difficult to find anything that really stands out at the moment.
Yeah, it's slim pickings. But I think what you just said about the perspective of looking at what the market is pricing in and then assessing those odds is probably one of the most important lessons in investing. And you don't necessarily have to make hard judgments on where the economy is going. You sort of have to just figure out and go backwards. What's the market thinking is going to happen, and how likely is that? And then just make bets probabilistically based on that. And I think that's just a better way to go. And that's just timeless wisdom from Greg Canavan. I think before before we wrap up, though, we can't not mention the Reserve Bank's decision. I know you've hated the decision. You didn't think it was warranted, but they did raise anyway. I think it was largely expected by other economists, and I think the market overall sort of expected it as well. The biggest takeaway for me, I think, was the statement. Usually, it's just a copy paste job. This time around, there were a lot of revisions. A whole paragraph was cut, a whole new one was added. But the biggest change was obviously about inflation expectations. The Reserve Bank is admitted that inflation isn't coming down as fast as it expected, and I think it's going to revise its forecast and going to release that on Friday. And that was the biggest takeaway for me. What was your biggest takeaway?
My biggest takeaway was the reaction of the bond market.
Yeah.
So the bond market fell. Sorry, I should say the bond yields fell and bond prices rallied. And that to me is an indication the bond market says, okay, well, this tightening is going to do the job and it will take more pressure off inflation. And we think that the RBA is done with this rate rise.
Mm.
Um, the reason, just to be clear, the reason I don't agree with the rate rise is because I just think there's limited
Yeah.
ability for monetary policy at the moment to continue to impact on the areas that need to be impacted. So, for example, a rate rise isn't going to create more gas and oil and electricity. A rate rise isn't going to create more housing that's
Mhm.
needed for our, influx of immigrants. So there's all these things that a rate rise is not going to achieve, yet and it will take second order effects for that to flow through. So if the RBA continues to think its rate rises should be having an impact on certain inflation, petrol,
Mhm.
electricity, housing, that they're kidding themselves. It's not. That's not where the interest rate rise has the impact. The interest rate rise has the impact on discretionary income spend. And I would argue that even though house prices have, out of every asset in the world, nearly all of them have gone down as rate rises
Mhm.
have gone up, except residential property in Australia.
Yeah.
And that's not because of monetary policy. That's because of the huge amount of demand.
Mhm.
And I would argue that in many cases at the high end of the market, there's a lot of money still flushing around asset markets, and people are buying a lot of these high end markets with cash from selling out of businesses or shares or whatever it might be. So um, they're putting money into the housing market from their business
Mhm.
transactions, but at the sort of more I guess generic part of the market, which is the middle class market, you got two income
Mhm.
households that are required to manage mortgages these days. So even though the amount of money that you can borrow is less, people are putting in, I guess, contributing more of their incomes in order to service those mortgages. The more money you have to use to service those mortgages is less money there is for spending elsewhere in the economy. So that will take a while to flow through, and that's going to have an impact on certain inflationary parts of the economy. But it's, as I said, it's not going to affect petrol. It's not going to affect electricity. It's not going to affect um, housing, and that's my criticism. And I know the RBA is caught between a rock and a hard place. If it didn't raise interest rates on Tuesday, it would have been absolutely smashed. It would have been considered not serious on inflation. It would have lost its credibility. So I can see why they've had to raise rates, but partly they ameliorated that by, as you said, changing some of the language
Mm-hmm.
in the statement. And I think that's what the bond market reacted to. 3-year bonds fell, which are particularly sensitive to the RBA's expected moves,
Mm-hmm.
and the 10-year rate fell reasonably considerably too. So I think it is going to bite. It is going to flow through and hurt the economy more. I'm just skeptical of whether you're going to get those moves in inflation
Mm-hmm.
that the RBA expects. And I think you'll see in those revisions that they come out with that they will be expecting inflation to stay higher for longer as
Yeah.
well. And that means rates will stay higher for longer, which will continue to put pressure on asset prices, the economy, corporate earnings, all that sort of stuff. Hence my I wouldn't say confidence, but hence my sort of feeling that this market hasn't necessarily bottomed, but we're just bouncing from those oversold conditions.
Yeah. Well, on that note, I think we'll leave it there until next week.
And I was going to say too, Kirill, if you do like this episode and you want us to discuss certain things that
Yes.
we don't discuss, feel free to leave that in the comments, and we'll try to get to it.
Yep. And I think from our last episode, people enjoyed your hair, Greg. That's the one takeaway.
Yeah, it's bizarre.